Hi, I'm Luke Tait, and we're here with Dave Young, and we're going to talk a little bit about the bond market and the future outlook. So Dave, there's been a lot of volatility in the stock market, and people have been looking for something that's really safe, so they jumped into treasuries, and that's caused treasuries to go really high in terms of expensive. What are your opinions on where it's going to go and what it means for people to go into treasuries in the future?
Well, the bond market is a really kind of a conundrum right now because, as you mentioned, for the last 30 years, people have moved into bonds for safety. And in the last 30 years, that's worked great because interest rates were as high as 18% 30 years ago, and they've come all the way down to 2% in recent weeks. And so as long as rates are flat or moving down, that's fine for bondholders, and they can count on that safety. So they've artificially got this idea that this is a safe place to go, because if rates move up at all, then you're going to see those bondholders take significant losses. For example, if on a 10-year treasury, if rates move up 1%, you'd take a 10% loss. If rates move up 2%, you'd take a 20% loss, 3% a 30% loss. So those kind of losses is equivalent to being stock market losses. So people moving to those bonds for safety may be surprised.
So when you talk about rates, you're talking about interest rates, right?
That's right.
And so when those interest rates go up, why are they so low right now?
Well, they've been pushed down by a number of things. The economy's been weak, so that's brought rates down because demand for money is less when the economy's weak. And then secondarily, the Federal Reserve has been implementing all kinds of strategies to keep rates down, with the idea that if they keep rates down, then it's easier for businesses to go out and borrow money, and to expand and grow. If they keep rates down, it's easier for people to go out and apply for a mortgage and make their payment. So there's a lot of stimulative effect by having interest rates down. And so the Fed is, essentially they've done QE1, QE2 in this twist program, all designed to keep the interest rates down. And that's actually kind of an issue too, because we had been, a few months back, we were recommending to clients to completely avoid intermediate and long-term bonds. They were on a sell signal because there was too much risk if interest rates went up that those investors would get hurt. But then a month or two ago, the Fed came out and said that they were guaranteeing that they were going to do everything they could to keep rates down through 2013, so over the next 2 years. And so with that in mind, that kind of allows you to move more into the middle of the yield curve. So, we don't think that you should just be in the short, but we think you can be in the intermediate term for at least the next year. And then you kind of got to be looking over your shoulder at what point the Fed is actually going to let the rates come back up, because at that point you will not want to own intermediate or long-term bonds.
So what are some of the things that in the future, in the next maybe year or two, that might cause the interest rates to go up?
Well, it's really all tied to the economy and the Fed. And the Fed has said they're going to do everything they can to keep rates down. So you kind of do a timeline out from when they said that, which was a few months ago, that for the next couple of years they should stay low. Normally, it's just demand. So as the economy starts to pick up, more people start to borrow money. Because there's more people borrowing money, there's less of it available. That pushes the yields up. And that's what will naturally cause interest rates to go up.
Okay. Thanks, Dave.
Thanks.